I think by and large, joining a startup, you really have to truly believe in the mission of what the company is trying to solve. The product and the services and the solutions that it creates could generate 10x impact or nonlinear scale nonlinearly for the benefits of the societies, right? Well, for the industry. And then lastly, I would say someone has to join a company where they truly appreciate the culture as well as the colleagues and the founders that they're working with.
Welcome to Concept to Care, where we hear candid stories of success and failure, discuss strategy, and dive into the details that offer advice on what to do and what not to do in health tech.
Whether you're a seasoned pro, growing your career, or just starting out, our aim for this podcast is to be relevant, real world, and tactical. We're dedicated to not only entertaining you all, but also empowering you with actionable insights that can be applied beyond the podcast, one concept at a time.
This is Angela.
And this is Omar.
Welcome to Concept to Care.
Today, we're thrilled to welcome Ian Chiang, partner at Flare Capital Partners and influential investor in the digital health space. Ian's journey from McKinsey to founding his own venture, to his entrepreneurial role at Cigna Care Allies, and now to investing gives him a rich perspective on what it takes to succeed in health tech. In this episode, we dive into some of the most exciting trends he sees today, like the impact of generative AI on healthcare operations and the evolving role of value-based specialty care. Ian also shares insights on what makes a pitch stand out, how to evaluate product market fit, and how healthcare startups can navigate today's capital landscape with discipline. His experience offers valuable guidance for founders, product leaders, and investors looking to make an impact in healthcare. We hope you enjoy this episode.
Hi, Ian Chiang. How are you?
I'm doing well, Angela.
We're so excited to have you on the show. So you've got an incredible background. You're a Taiwanese American. You went to Cornell for undergrad, Harvard for your MBA. And your career I found very inspirational. You went from doing research to McKinsey to being an entrepreneur. And then from there, you were an intrapreneur within Cigna at Care Allies. And now you're with Flare Capital as an investor. You also chair some cool conferences like Next Health Summit, and you're the proud dad of 2 kids. How did I do with your intro? Anything to add?
No, you covered all. Thank you.
We're excited to talk to you today and just get your perspectives. So we'll go over some things with, trends and what you're seeing as an investor, especially around AI. We'll talk a lot about go-to-market and joining startups, and then a little bit about your transition to a VC.
Sounds like a plan.
Ian, we want to start off with the macro trends here. So you've said yourself that right now it's the most exciting time you've seen in digital health and in the general health landscape. You as in the VC, right, have a bird's eye view on so many up and coming companies and innovative ideas. Tell us about some of the macro trends in health tech.
Sure. And thank you, Omar and Angela, for the questions. So as a venture investor, while the last couple of years, there were some ups and downs. And of course, we have seen a peak during the COVID era. But I think this is actually a period that's more exciting than even during the COVID era. I would say, in addition to just a lot of what we have seen over the past couple of years in the rise of tech-enabled services, we're also seeing technology, especially in generative AI and large language model, that are now starting to pick up momentum, and we'll be able to create the kind of impact that the previous generation of AI tools have promised, but have yet to be able to deliver. So from a macro market point of view, we're really excited about the technology trends and also the emergence of the generative AI and large language model application within healthcare, of course, starting with some of the more on the administrative and operational side of the house. Another area of strong interest, and I think we're still solving for a ton of unmet needs, is on the specialty curative side. of the house. Over the last decade, or even one could argue 2 decades, there was a strong movement towards value-based care. And of course, we have seen the emergence of direct primary care or advanced primary care, including some of our FLAIR portfolio companies like Iora Health. But as a former operator, we all know that in order to truly get us to maybe there won't be a holy grail or an end state of value-based care, but to get as close to it, we really need to control the specialty care costs. So over the last several years, we have seen the emergence of a number of really high-performing virtual specialty care or value-based specialty care provider, like in the oncology, in the cardiology, in the MSK space. So really excited about, I personally do believe that there are still big companies to be created in those specialties I just mentioned, but there are also emergent specialties like GIs. So those are a couple of the areas. And of course, mental and behavioral health is still an area of huge unmet needs. We just simply don't have enough supplies to ever address the insatiable demand of the behavioral health. So I'm still really excited about companies that are tackling and trying to address the unmet needs in the mental and behavioral health space.
You got me thinking when you mentioned AI first and then you followed up with specialty care. You know, both Angela and I come from a specialty care, value-based care provider, and AI is also a very big topic and something that we like to share back with our investors. Like, we think our unit economics are going to be improved with the new age of companies that are coming out. Do you guys view it the same way, where you think as these AI companies sort of mature, that the specialty care companies will start to deploy AI a bit more, and that next layer of better unit economics is going to come from that, or more so just better execution on their care model?
I think it's a little bit of both, right? So I think there's no way AI or any technology is not the silver bullet to solve the unmet needs, right? So ultimately, whichever companies, especially coming from the specialty side, right? It's the care model, it's the clinical, the frontline employees, the people who are touching the patients, right? They're the one creating the impact. And of course, there are some novel business model as we're looking at many of the specialty care because of technology and also because of the innovation care model. They're more and more willing to taking on novel risk arrangement contracts, right? So that to me is an area of business model innovation. But I would say technology is such an important ingredient to our ability to be able to scale any of these assets, right? Like any of these specialty model. Because I think, as I mentioned in behavioral health, but we can look across all specialties, right? We have a shortage of providers, MDs, other care types of care provider. AI tools will be able to amplify and multiply the supply of our very scarce resources, right? Like one of my portfolio company, we joked around the company's chief medical officer is this industry luminary, right? And we needed to be able to replicate her in all the markets and every single one of their assets. Obviously, we cannot clone her. So the only way we can do is leveraging technology, using AI to perhaps create clinical decision support tools that can empower someone who's less experienced and less well-trained to be able to provide the kind of triage diagnoses the same way that Dr. Angela Fitch is able to do. And of course, be able to scale the care delivery in a nonlinear fashion, right? And bring down the costs, because we also face another challenge, which is the costs that currently exists in our healthcare system to make many of the care, make it very unaffordable from a consumption side.
I wanted to give a plug for a write-up that FLAIR recently did which was about the 10-year look back of AI funding. And we'll plug it in the show notes, but it was talking about where the investments have landed and does it match the AI hype. And when I looked at that write-up, which was terrific, so with all new technology, we're going from something like the peak of inflated expectations, and I think now we're following down that slope to the trough of disillusionment. At the same time, I don't feel like AI as a technology is going anywhere, right? I think particularly in healthcare, this is the technology that we've been waiting 30 plus years for. You've already gone over some of the cost benefits and some of the benefits of scaling expertise. I think also a lot of healthcare is very analog. A lot of the workflows are very arduous that could be automated. And then I would also combine that with the shortage of healthcare workers in general. Can you give us your take on some of those things?
Absolutely. Flair, since the inception, we've been very actively investing in the AI space tools, as well as companies leveraging AI as part of their care delivery. Of course, like all innovations and all technologies, it will go through some ups and downs in terms of the cycles, just like the way you described. We have segmented the overall AI landscape by the different user types, like payer, provider, life sciences company. And we have seen, of course, there are some use cases that have gained tractions much faster, rapid deployment than some of the other use cases. I would say, just from my personal point of view, AI is not hype, right? And a lot of what we have seen as an investor, of course, there are a category, many companies that are building AI tools to enable better care delivery, more efficient administrative, better operational workflow, reduce inefficiencies in our existing system. But I think I'm also very excited and actually, frankly, perhaps even more excited is to see that a number of our companies, be it within our Flair portfolio or companies now we are seeing emerging that really already build upon an AI native technology stacks, right? So I would say the past 10 years, we have seen primary care or specialty care delivery or behavioral health care delivery companies that are digital first, digital native. And now we're starting to see a whole generation of companies that are going to be AI native and to be able to deliver care delivery in such a cost-efficient manner by leveraging some of these tools that 5 years ago, we just frankly could not have imagined. Right. So this is a really exciting era for us when it comes to an AI revolution. Of course, we're being cautiously optimistic. A lot of the policies and regulations are still evolving. But we do think that just like in other industries, AI will create a profound impact to transform the industry for the better.
Thanks, Ian. I want to switch over into our audience is made up of product managers, product leaders, operators, entrepreneurs, investors, and founders, et cetera. And I think you have a very good perspective given that you sit and see so many pitches. So I want to talk about the pitch. Just generally, you see so many, what makes a company stand out when they're pitching?
So as a VC, so Flair, we invest across the full life cycle of the company, despite our entry point tends to be earlier in stage, right? So I would say seed A and B tend to be the phase that we start our investment. For every dollar we invest, we've reserved $2 to $3 for follow-on investment. So we also continue to partner with our portfolio companies throughout their life cycle. I would say when I look at companies that come and pitch to us, right, usually at the early stage, the team and jumps out, right? So I know it's kind of cliche. People talk about the TAM and the team, right? But that is really what we look for. The earlier we go, we try to prioritize the team. And it's not just a founder. Of course, we place disproportionate amount of our effort and diligence on the founders. But we also look at the broader team, right? So who's on the team, and also who are the advisors? Has the founder been able to build an ecosystem of a network of great people, right, to help them succeed? On top of that, we also look at, the founder market fit, right? Again, not to sound too cliche, right? Like, we do like to understand founders' motivation and why she or he wanted to tackle this very thorny problem, right? But as we move later and later to across some of the company, what was stood out to us is really the commercial traction. So we always would start looking at whether or not there are signals in addition to the product market fit, but the ability for the company to be able to grow in an efficient manner, right? So, of course, the later we go, probably we have more data to analyze. But in some ways, we don't need to be able to see $10 million of revenue to justify that. But if an entrepreneur, a founder, can come and show us evidence of what would help the companies to go from 1 customers to 10, and to be able to show us the evidence, that will really stand out to us. And lastly, I think what I personally also look for is companies that has unique business model, right? So to be able to truly, I think personally coming from that value-based care enablement background, I firmly believe in that the only way for us to get out of our current healthcare, many of our affordability crises, is to be able to move towards value, right? So the companies that are willing to be able to go from, it's okay to start with fee-for-service, but if they have a clear path towards to move their payment model to across the value-based care continuum, fee-for-value continuum, I think that's what stood out to me, right?
So that's a great perspective. And I'm wondering, just curious, what stories that you've heard recently that's resonated really well, and what stories or pitches that you heard did not resonate well? And, feel free to withhold any sort of information that feels necessary.
Yeah. So on the story that went really well side, without naming the company or going into details into some potentially confidential information, I think one of the companies like that went really well, not just with me, but also with our partnership, was the founders were able to come in, share with us a clear articulation of what exactly the problem it's solving. It's a little bit of a later stage company, so it has a lot more financial data to be able to show, but the clarity in terms of showing the growth, as well as its approach to acquire customer in an efficient manner, I think that stood out, right? Especially for early stage investor. We weren't anticipating a company at that stage to be able to track the magic number for the past 3 years, right? And this company was able to proactively share that with us. I think for any financial investor, especially coming out of this growth at all costs kind of a mindset or face of the market, I think the more a founder is able to show the financial discipline, I think that resonates well with the investor. And even if we all understand no one can really predict the future, but the fact that an entrepreneur is able to be thoughtful and then to be able to walk us through the financials in such a detailed manner, I think that resonate well and lends a lot of credibility to us to believe that they will continue to run the company in a methodical, thoughtful, and disciplined way, right? And the other thing I would say that company really stood out and resonated well with our partnership is the simplicity of the product, right? So it's a provider, it's a solution that sells into the provider. The value proposition for the customers, in this case, the provider, is just so clear, right? And so intuitive. In some ways, it's so novel, and yet you're like, wow, how come no one has ever thought of that? So when a company can clearly articulate the business model in a very simple, intuitive way, I think that will always resonate well with the audience, right? Be it an investor or a customer or anyone else. On the flip side, I think, Omar, you asked the question about pitches that did not go well, right? Like, I think oftentimes, I think similar, like, if we can really understand the product until 15 minutes into the presentation, I think oftentimes I would say we get many of those pitches during a week, right? So those are usually, no matter how great the company is, it's just a challenge for us to be able to lean in, right? And I think one thing entrepreneur may not appreciate is, like, at any given moment, every single one of us is trying to balance a portfolio of sometimes double-digit number of companies that we need to work on at various different phases of the diligence, right? So I cannot stress the importance of to be able to tell a linear, crisp story, tell us what the product does, right? And what's the business model, and what kind of unmet needs you're solving, right? And what's the mode? I think by and large, companies that didn't perform well during the first pitch often don't tell a very clear story, given the short amount of time we have with each of them.
Got it. So for those who are listening and have pitches coming up, if you time yourself and make sure, if you haven't mentioned the product and what it does in the first 15 minutes, you need to revisit. Ian, you mentioned magic number. Can you what is that? What is a magic number? What does that mean?
The magic number I was referring to is the SaaS magic number, right? Like, so I think the formula is current quarter revenue minus the previous quarter revenue multiplied by 4, and then divided by the previous quarters of sales and marketing expenses. It's a metric that we use to look at how efficient the sales is, right? And how quickly it grows. Obviously, it's a number that, of course, the higher the number, it means there's a greater the efficiencies, right? Like, because you don't need to spend as much on the sales and marketing side to increase your revenue, like from quarter to quarter basis. However, it also just shows you perhaps a company may have underinvested in the sales and marketing, right? I think coming out of the growth at all costs, like kind of mindset, we have seen so many companies, right? They need to continue to increase their sales and marketing costs to chase the next dollar, right? So I think as a technology investor, health tech investor, we're now a bit more over-indexed to companies that can grow in an efficient manner, right? So in that case, this is a company like whose magic number would suggest the company has historically perhaps underinvested in the sales and marketing, right? And from our point of view, we would love to be able to invest in the company to help them build the commercial infrastructure, because we know that even with the limited amount of resources they have had, they were able to grow in a very efficient manner. So now we can really leverage our capital to help them get to the next stage. There are other metrics you can use to track that. So I was impressed the company has such a thoughtful quarter by quarter, year by year tracking of the magic number.
Now, tell me about a story where the startup pitched to you, the pitch went great, and then they didn't get the term sheet. What happened?
Well, I would say also it varies by the different phases of the companies, right? So I think as a former entrepreneur, I also pitched to a lot of the investors. I thought the presentation went well, and somehow did not materialize into a term sheet. And when I decided to switch sides about 5 years ago, one of the things I really wanted to learn was to understand how venture investors make decisions since I have always been on the other side of the table, right? I think for the past 5 years, what I have seen is any venture investment has a multifaceted approach. The pitch could have gone well. And then I think one of sometimes the entrepreneurs don't see the type of work we have done behind the scenes when it comes to diligence, right? And also the kind of underwriting models that we have to put together to justify the investment. Because ultimately, in addition to loving the product, liking the company, loving the founders, we also need to be able to underwrite to an exit that be able to uphold our fiduciary duties to our LPs, right? So our investors. So oftentimes, I would say, even for the companies we love, we didn't get to the finish line, getting to a term sheets. It's often because of the stage, right? As an example, oftentimes when we look at an earlier stage company, love the technology, love the founders, but many of the earlier stage company, their business model can evolve in many different directions, right? So for us, the benefit of being a fund that can invest seed A and B, right? We often would say, okay, we would like to see the company mature a little bit more before we lean in a even more meaningful ways, right? And as evidenced by many of our portfolio companies that we invested at Series A or Series B, we have been talking to the founders since when many of them just started the company, or even before they even started the company, when it was just a concept, right? So I think my advice to founders is don't take any one pitch, don't go on the extremes, right? Don't a great pitch. Don't think that it's just because it's a great pitch that will quickly lead to a term sheet. But also don't be upset if the pitch didn't go nearly as well, or even a great pitch that did not lead into a term sheet, right? But I would say partnering with the investors, because here's one thing I would say, right? And one thing I've learned now that I switched side is your deal sponsor, the person you pitch to on the venture side, they are also pitching to their partnership, right? So it's really a collaboration. It's a partnership to partner with the investors to get to a term sheet.
Just thinking about, you guys invest in various stages of the company, early to more mature. As time progresses, the cap sheet gets more investors, and I'm wondering what your thoughts are around cultural fit between the startup and the VC, and where have you seen the cultural misalignment lead to tension, and how do you identify that early on in the process and kind of just resolve it in a favorable outcome for everybody involved?
Yeah, no, for sure. Omar, as you said it nicely, right? As the company grows, there will be more and more investor on the cap tables, right? So I think, of course, this is really a two-way street, right? It's as much as the VCs are evaluating the companies, the founders for culture fit, as well as it really should also be the other way around, right? Founders should also evaluate the VCs to understanding whether or not they are a good match, right? So I think from me personally, and maybe having been on both sides of the fence, I would say transparency is paramount, right? I think it's always great for the entrepreneur and then the venture investor be the lead or whomever is part of the syndicate, right? To be very transparent about the intention, right? Why? What's the motivation behind building this company? What would be that ideal outcome of the company, right? What value adds the VC can bring, right? What do the startup need, right? What does the founder want from the VC, right? I think the sooner the two sides can be transparent about their intentions and their optimal desired outcome, I think the better it is, right? Obviously, sometimes things could change like from round to round, but I think having that kind of transparent communications, I think is what I have seen the best way to build a successful relationship, right? In some of the cases, I think that misalignment in terms of expectation is probably what gets the investors on the cap table and the management team or the founders get into a little bit of a disagreement, right? So I will always advise upfront transparency and don't be afraid, right? I think a lot of the founders I have seen, they're so eager to convince a venture investor to invest in their company. They will say whatever in their mind, what they have found out, what the VC wants to hear. At the end of the day, you just have to be true to yourself, right? To the type of company you want to build and the kind of people you want to be surrounding yourself with. So I think just try to be genuine, right? Be authentic to what you set out to be, since building a startup is such a noble pursuit, right? So you want people who are fully on board with that mission.
Ian, I loved what you said. I'd love to double click on that. When you say, and I agree with you, I think that people who are building organizations, they are very eager to impress the VCs during their pitch. I'm curious, you said something that I really liked, which was, what value does the VC bring? So if I am a founder and I'm pitching to various VCs, what would you say different VCs can bring and how would you evaluate that?
First and foremost, venture capital investors, or any investors, we bring capital, right? But obviously, I think someone once reminded me, everyone's dollar is the same shade of green. So I don't think anyone will be able to purely differentiate based on the capital, right? I think what I have seen, and we also strive to do that at Flare, is so number one, I think on the personal level, right? As an entrepreneur, you are looking for your investor, be lead investors or others on your cap table, is for that person to be able to be there for you, right? Through the thick and thin, as well as the ups and downs of building the company, right? So I think sometimes I would say when I was still building a startup, I probably spent more time talking to my advisors and even angel investors more so than to my wife. Right. So I think some of my angel investors got me through some of the toughest times, right? So to be able to find an investor who's truly invested in you, that's so important, right? That's something you can't even measure based on the put in dollar terms, right? Or concretely. But other value adds, I would say, right? Many of the investment firms, including Flare, we have platform teams, right? So especially as an early stage fund that partners with many of the early stage founders, even repeat founders, many of them have not been able to navigate, like, for example, on the PR side, right? On the marketing side, on the operating side, on the operations, on the legal sides, right? I think great investors, value-adding investors will be able to provide not only the experience, but even some of the hand-holding to navigate founders, repeat or first-time founders through some of those company building processes. One other area I would say is probably most particular to healthcare entrepreneurs is great investors in this space bringing experiences and network to be able to make the proper introductions for portfolio companies. And I would say, as an example, right, Flare, we track this number. So since we have dozens of strategic LPs and our portfolio companies tend to sell into many of our strategic LPs, right? So we actually track this number over the last decade. Our portfolio companies sold over $800 million worth of revenue into our strategic LPs. And of course, I will always say, as a former operator, like, the entrepreneurs and the teams are the one doing the hard work, right? But I have seen firsthand how some of the valuable introductions that can be made by like valuable funds like Flare and others that can materialize into acceleration of a contract being done, right? So I think those are some of the value adds, like especially in healthcare, it's really valuable, right? Because many of these enterprise customers, but they buy early stage company based on confidence, right? Like, so if you can get an investor that they trust to make that recommendation, that can accelerate the commercialization and go to market by quite a bit, right? And those are sometimes, especially in healthcare where, the sales cycle is so long, right? It could be 12, 18 months long. So any sort of acceleration, any sort of a boost can make a huge difference, right? Like to an early stage startup. So I would say those are some of the things that great investors bring in beyond just their capital, right? And one last thing I would say on the value add, I think oftentimes it's hard for any investors to tell an entrepreneur what they should be doing because we are not as close to the market, right? We're not seeing the data, but having spent quite a number of years on the payer side, there are certain things I can probably tell people not to do because I know it's not going to work. So sometimes I would like to think that some of our value add is to share some of the mistakes we either have personally made in the case of myself, or what we have seen other companies have made, and then to guide the entrepreneurs and the startup to a direction where they can save a few cycles and not repeat the same mistakes other people have made.
So Ian, you shared that with Flare, you typically invest in seed stage, Series A, Series B. Oftentimes at these stages, the organizations are still looking for product market fit. Can you talk a little bit about strategies to find product market fit quickly and how, as an investor, you're able to guide organizations to do so?
Yeah, no, great question, Angela. And of course, different stages, we look for different product market fit signal. But from the very early stage, right, I think the general rule of thumb, at least I personally look at, I think most of the investors would look at it, is whether or not there's, number one, people using it. Two, are there enterprise customer in the healthcare settings interested in the product and willing to use it? And then the third is really, and perhaps the most important part, right? Are people willing to pay for it? Because ultimately, we're still backing companies that are going to hopefully go on to become very successful businesses, right? So at least in healthcare, slightly different from maybe some of the consumer tech, that you just need to build up the user base and trying to find ways to monetize later, right? By and large, healthcare companies, you need to have a pretty well-defined business model early on in order to move to the next stage, right? So I think those are the three kind of dimensions we look for product market fit, right? And I think we have invested in companies that have lots of users early on before they have clear, the end stage business model, right? They can start with fee for service and then having a number of, customers, be it patients or the providers, right? But with a clear view on how to evolve their business model in the long term. So I would say, but ultimately what we look for is the buying signal, right? And I think reflecting that in a P&L statement or the ability to put a large enterprise customers in front of an investor and validate their interest in the solution and that they are going through contracting process, right? So I think those are some of the ways for us to evaluate the product market fit for the companies, right? And of course, as we look at later stage companies, we're hoping that to be able to see replicability of that business model, right? To truly validate that there's a true product market fit, and many people, many organizations are willing to vote with their dollars, right?
Let's talk about when the company's coming off the ground, and there oftentimes is a tension on what to build and how to allocate resources. Can you just describe to us, like, what do good decisions look like in capital allocation in the early stage?
Yeah, no, great question, Omar. And of course, depending on a Series Seed versus a Series B company will have different types of capital allocation profiles, right? But I think let's start with the early stage, right? Like if it's truly early stage, I think, of course, quite a bit of capital should go into developing the product and the solutions, right? Like since if you're building like a care delivery business, you have to be able to hire clinicians, right, to provide the services. And also if you are a software platform, right, like especially let's say selling into an enterprise customers, right, no one is going to just buy a bunch of wireframes, right? Like they need to be able to see the actual product at work, right? Like, and then, a large payer or health systems, IT department or supply chain or security team, compliance team, they need to be able to evaluate the technology, right? Review the source code. So you have to be able to build something, right? So right off the gate, like obviously building that product or that tech-enabled services to be able to demonstrate product market fit will be important, right? But one area I think we shouldn't underinvest, like one shouldn't underinvest is also to have the commercial team, right? Like, so oftentimes, of course, startups are founder-led sales, so that's totally fine. But we would like to see founders or entrepreneurs, management teams to place a little bit of emphasis on investing into the commercial infrastructure, right? Especially if a company is looking to scale like quickly, having the ability to, it doesn't have to, you don't need to hire like a chief commercial officer at the seed stage, right? Like, but to be able to invest in building that, sort of a commercial infrastructure to be able to scale the company will quickly test out product market fit in different categories, different customer segments. It's pretty important, right? And we have seen some of the best companies that are able to scale quickly is because of some of the investments they have made in the early phases.
I want to pull on that a little bit. Commercial has always been very peculiar and hard, I think. And why I say peculiar, it's like, let's talk about specialty care and value-based care arrangements. Value-based care arrangements, through the contracting process, it's pretty complicated, right? And you mentioned like early on, founder-led sales makes sense, and then eventually invest in the commercial team. I wonder what that looks like. Like in a SaaS environment, yeah, like we should be investing in that. We should be bringing on other resources. But I've also seen in some cases where like the deal cycles are very long, and the deal itself is pretty complicated, and it's very network driven. It's very like does the founder even know people at the payer, or you know what I mean? And so, what do you think about those kind of businesses, and like how does that commercial spend change?
Yeah, and I would say clearly, healthcare, especially in B2B enterprise sales kind of environment, network and relationship is critical, right? Like I don't want to I don't want to ignore it, because many people buy solutions from people they know well, right? And when I was still on the operating side, I used to joke around. It's like, that's why the best product oftentimes it doesn't win in healthcare, right? Well, in many of the B2B settings or highly regulated industries, right? So I think when I talked about commercial infrastructure, like doesn't mean that you need to build out like an an army of salespeople, right? Like hiring a chief commercial officer and build a sales organization or growth organization of a Series B company. But I think the ability to invest into not just, it could be an individual or a network of individuals. And we have seen startups done a very good job in terms of building an advisory board, right? Commercial advisory board. And some of that is like very incremental investments, and that can go a long way, right? Like as Omar, you described, like the network effect, right? And then also the other thing I would say, and not to plug for any investors, right? And but also maybe tied to some of the value add questions that Angela brought up like a few minutes ago. I think having the right investors around the table, I know oftentimes early stage founders tend to want to minimize the dilution, right? But I think in some cases, bring the right investor and sometimes even take on a little bit more dilution to have more value-added investors around the table. Like investors could also serve as an extension of the team, right? So I think that would be another way to invest into that infrastructure, right? Like, so maybe it's not a direct way from like you raise capital, where do you invest, right? So, but think about, as an entrepreneur, think about if you can bring in more capital and from more value adding parties, that could even amplify the effect, right?
Ian, I loved how you were able to boil down product market fit into those 3 areas to look for. As a follow-up to that question, what would you say are mile markers to look for so that startups are able to start to prove out their ROI? And have you seen a company do this well?
I think for us, like obviously different types of company will have different types of metrics that we measure them to. We'll measure product market fit, right? Like a SaaS only company will be very different from a tech enabled services company. So I don't want to generalize a set of specific metrics, right? Like just cuts across all the like different types of business model that we invest within the healthcare subsegment. But I think by and large, we want to be able to see growth in customers, right? Like in users. So I think even for a company that's quote unquote may or may not have figured out the long-term business model, right? We want to be able to see signals of customer growth, right? And user growth. So I think that's pretty universal no matter what kind of a business model, right? Like, I think too is, I think in healthcare space, I think by and large, like people use NPS a lot, right? So we do like to look at companies like whether or not we can measure the NPS score, right? Like, so of course, higher the better, but we often use those as another kind of interim milestones, right? Like to see whether or not the company is like truly gaining product market fit, right? And maybe one other set of metrics we will also use is to look at certain gross margin profile, right? And whether or not the gross margin will continue to trend favorably, right? Like, I think that also tells a lot because if you can see improvements in gross margin, that shows there's a leverage, like the company could scale it like in an asymmetric manner, right? So obviously we won't be able to tell the end stage gross margin for perhaps another round or a couple of rounds later. But for companies that are able to show improvement in gross margin, I think that goes in a long way, right? So even for early stage startup, as soon as they start shipping products on the software side or deliver services, could be AI enabled or tech enabled, we would like to see, like their overall gross margin profile and then how the cost of goods sold or cost of service trends over time.
Ian, I want to switch the framing of this conversation. As a VC, you're often evaluating startups. Let's think about the perspective of the product person thinking about joining a startup. In tech, there are product managers who are in a much safer, higher income situation, maybe just a lot more stability in a more mature company. And when you go into a startup, there are trade-offs there. I'm curious what your thoughts are. Like if you were a product person or going back to your entrepreneurial experience, like what are the best outcomes or things that you should be looking for that would render the best outcomes if you're a product person evaluating startups?
Yeah, no, great question, Omar. And I think I'll start with some ways of thinking about startup career, even just perhaps universally true before diving into product people specifically. I think number one, if someone has a very good job, like maybe from a large company, Google, Facebook, or like one of the larger companies, and thinking about joining a startup, right? Like, I think by and large, I would say you have to join startup for reasons other than financials, right? And also lifestyle. Because I think if someone wants to join a startup just because of the opportunity to optimizing on the financial side as well as optimizing on the lifestyle side, I think the person should just stay at his or her current employers, right? Because that should not be the motivation of joining a startup. I think by and large, joining a startup, you really have to truly believe in the mission of what the company is trying to solve, the product and the services and the solutions that it creates could generate 10x impact or scale nonlinearly for the benefits of the societies, right? Well, for the industry. And then lastly, I would say someone has to join a company where they truly appreciate the culture as well as the colleagues and the founders that they're working with, right? So I think that those are the three things. Like for anyone thinking about going from a large company or like a very high-paying, stable jobs, and to make that move to a startup settings, right? I think on the product side, I would say maybe three things I will also look out for if I were a product manager joining a startup, right? So number one is the learning aspect, right? Like whether or not the company is building something that you can not only contribute right away, but also to be able to learn and advance your technical or products like experiences and skill sets to advance your career, right? So I think oftentimes we hear people from large companies like they feel like their learning has plateaued, right? So there's no better place at a startup setting where you can challenge yourself and excel your technical skill as well as many skills across many other facets, right? And being a product manager at a startup is truly drinking from the fire hose. I think two is some levels of autonomy, right? Like, because I think being a product manager at a startup, you're almost like you're running the certain parts of the product. You also have to have that CEO mindset, right? So I think to go from a large company to a smaller company, it's really about like building and developing that general management and mindset. I think for a person who are like looking for that types of challenge, like joining a startup will be quite rewarding, right? And lastly, I would say to go from a large company to a startup, right? I think ultimately you want to be able to say you are doing something meaningful, right? Like you're not just a cog in the wheel. So I think for a product person, that's the type of impact you want to be able to create is you have to be convinced that you can only create the kind of impact at a startup setting, right? So those are probably some of my advice for people who are going through that career transition to trying to evaluate large company versus a startup, right?
And then Ian, I think that the cap table can also reveal a lot. And so if I'm a prospective candidate, what can the cap table signal to me?
Well, so obviously I would encourage anyone who's considering a startup job to really understanding who's on the cap table. And obviously some of the details might be harder to find from outside in, or you're not able to get to that level of granularity even during the interview process, right? But I think number one, on the investor side, right, I would absolutely make sure look for if there are investors that you strongly believe that they will be value add, right? So I think so much of the success of the company, like having the right investors on the cap table, can signal at least the likelihood of a startup to succeed, right? Like so I think that's number one. I would absolutely look out for, right? So there's a reason why people gravitate towards taking money from brand name or established investors, right? I think the other thing I will also call out is maybe today is more of there are many incubators or companies that are kind of leaders type of firms, right? And companies spinning out of an incubator. I think one thing I would look out for is just the cap table structure to see how it's being divvied up, like on the fully diluted ownership standpoint between people who are actively at the company, adding value and contributing to the future of the company versus people who are more of have added value in the past, right? So I think oftentimes we have seen cap tables that may need to be reworked, right? Just because of, perhaps the new set of employees are not getting compensated from incentive standpoint the same way due to certain characteristics of the cap table, right? Like, so I would definitely, as anyone who's considering joining a startup, right, to make sure that there's enough option pools being created to for recruiting employees as well as executives who will help the company get to the next phase of its growth.
Ian, you made me think of a follow-up to that. I'm thinking about we came out of an economic climate where the interest rates were low and capital was cheap. We moved into a higher interest rate market where capital became expensive. And we were and you guys are high conviction investors. Mm-hmm. So your perspective on this would be really interesting. I hear from a lot of product leaders, like, they don't know if they're joining a company where the equity is just in the water and they don't really know if it's worth it, like, because it's still a lot of work and they are in a high outcome position, and so they see a lot of hurdles in front of them. So how do you know whether the equity is underwater and whether it's if maybe that's okay? I don't even know.
Yeah, and is really good questions, and in some ways it's nearly impossible to tell, right? Like, because we have seen, just in the market, right, plenty of startups that seemingly doing really, really well, and then suddenly, run into troubles, right? And then, but we have also seen startups that seemingly stalled for many, many years, may not have gone anywhere, and then maybe not suddenly, but over the years, growing like in a very healthy pace, and then ultimately end up to becoming a really a very successful companies, right? So I think, Omar, that's the having also gone through being on the early stage startup side and now as an investors, right? So I think for anyone joining a startup, you really cannot put financial motivation as your I almost have this, we encourage people to have this mindset, right? It's like, you have to believe in the company, you have to believe in the mission, you have to like the people you're working with on a day-to-day basis, you have to believe in that you are making a difference to make healthcare, make our world a better place, and then money is secondary, right? Money will follow. If the company is creating differentiated impact, disproportional amount of impact to the customer, it will be able to capture the financial value, and ultimately it will be reflected in the stock options, right? Like so I think first and foremost, just it's really hard for anyone to predict which company is gonna end up being successful. So don't spend too much time trying to calculate, whether or not my stock options under the water was suddenly, like a millionaire because of the company, and go on to raise a couple rounds of really nice up rounds, right? Like just focus on the day-to-day value creation and let the money to follow. But of course, if someone is leaving the company and needing to exercise the option, then it has to place a bit more of, need to think through that carefully, right? Like, because there are a lot of companies that are sitting at a very high valuation, not just in healthcare, but just in general, right? Like, whereas exercising the option may or may not be the most prudent financial decisions for someone's from a personal finance standpoint.
All right, Ian, we would love to hear your insight into the transition over to a VC. What are the main considerations, and how would a person know if they're ready to go from player to coach?
That's an interesting question, because I have actually, if you ask me this question ask me whether or not I'll become a VC 6 years ago, I would say, like, you must be out of your mind. I never thought of myself as a VC, right? And of course, I had the great fortune of being able to join the team at Flare. So it was a very happy and lucky coincidence. But for a lot of the former operators, founders who are looking to becoming a VC, I would say it entails a very different kind of a career track and use different types of muscle, right? Like, so I can't really say when the person will be ready, but I would say, I think most of the people, if you go from an operator to becoming a venture investor, one of the most important things to watch out for is the willingness to partner with an entrepreneur without being very without being there on a day-to-day basis, right? And then also kind of letting the entrepreneur to be able to operate and learn from the process rather than being prescriptive and then to be telling them what to do, right? So I think I love your analogy using player versus coach, right? Like, I think it's our job to be able to share some of our learnings and wisdoms and also our pattern recognitions as an investor with the entrepreneurs. But also, I think it's also very important for us to develop that two-way, like the bi-directional, like kind of the feedback loop, right? Like to truly create that fluid communications that we can coach each other, right? Like to help each other, progress and get to the same goal, right? So I don't think there's a time like I could say, yeah, this person is ready. And I would say probably we're never fully ready, right? Like, but I think it's more of a change of mindset to go from needing to be in control of everything to now being able to willing to share the experiences, be a good ones or some of the past failures with different peoples. So hoping that they can do a better job, like a much, much better job. And by and large, entrepreneurs are the ones who are always doing a better job than the investors who were a former operator.
All right, Ian, thank you so much. So we've reached the exciting concept closing call portion of our show. It's meant to be fun and fast lightning round. So we'll ask you 5 questions and you answer them. First question, are there any frameworks, methods, or processes that you found to be especially useful in your work and that others might also find to be useful?
As a former product and solution person, I have always found the jobs to be done theory to be extremely valuable when it comes to building and developing products and solutions. Another one is the non-consumption theories. I would encourage all product leaders, as well as people building products in healthcare, to read up on both of those theories and frameworks.
And what is a tool that is highly valuable to you that you think others may not be using?
Again, I have found Professor Clayton Christensen's disruptive innovation theory to be one of the most valuable tools when it comes to evaluating the true disruptive potential of a technology. One thing I would call out is that many people use disruptive innovation to describe any situations. I would highly encourage folks to reread or read up on the innovator's dilemma and the innovator solution before applying this theory.
Are there any concepts in healthcare that excite you outside of some of the macro stuff you've already shared?
I would say many, but as an investor, as well as a former product builder, I would always use the concept of value-based care, as well as the quintuple aims. I know we have evolved from triple aims to quadruple aims and now quintuple aims, but I will always recommend people to apply what you are building using the quintuple aim theory, because if you're solving one or many of the aims, then the product will have someone who will find it valuable.
Do you think that investing is an art or a science?
That's a great question. I would say investing is both an art and a science. The earlier we go, the more art it is, since there's not much data to analyze. But as we're looking at some of the later stage deals, it definitely becomes more of a science. But of course, as an early stage investor, no matter how early or late we go, we have to apply both muscles.
All right. And now, Ian, where can people get in contact with you if they wanted to reach out? And do you have any shameless plugs?
And thank you so much for having me. I would welcome anyone to reach out to me, both people building companies, building products, fellow investors, fellow operators, just anyone. Feel free to reach out to me. Anyone can email me at ian@flarecapital.com. Well, they should be able to find my contact information from both of you. Thank you so much for having me on this podcast. I thoroughly enjoy all the thoughtful questions that both of you ask, and cannot be more grateful for the opportunity, and looking forward to meeting many of your listeners, and together we'll make healthcare better. Thank you once again.
Hey, thanks so much for listening to the show. If you liked this episode, don't forget to leave us a rating and a review on your podcast app of choice. And make sure to click the follow button so you never miss a new episode. This episode was produced and edited by Marvin Yue with research help from Aditya Triya. We're Angela and Omar, and you've been listening to Concept to Care.